This is Q2 2022 Regions Financial Earnings Call Summary. It is earnings season once again, and I have a lot of earnings calls to go through. This is, um, well, the second, I guess. Paychecks was the first, first in a while though. So number one, great quarter. They beat on both earnings and profit. Let me just double check that, but I'm almost certain that is correct. Yeah, beat on both profit and revenue, which is really great news. Um, this is definitely a company that I expect to do well in a rising interest rate environment. So let's go through and take a look as to why that is. So number one, um, they are still growing their business. They're going more into money center services type of bank rather than just a typical regional deposit, checking, loan type of bank, which is really good because in the rising rate environment, you want to be selling loans, right? And so um, here on the left column, they talk about their treasury management, which this is dealing with cash management and businesses. I think that's just kind of an add-on, right? So if you already have a client, your client may be dealing with you for maybe only payroll or maybe only they have a personal account at your bank. But if you have a business and you need treasury management, then the bank that you're already a member of, that you already have an account at, can then service you with this particular service. So this is the kind of growth that they're looking at doing. Essentium is a company they picked up quite some time ago. I forget exactly what they do, but either way, you see there they are growing that 30% clip. The SBA lending is something that they're expecting to continue to grow. Sabal, again, I forget exactly what these guys do. I think this is maybe the home improvement company that they purchased a while back. They're growing that by 11%. And then ClearSight says robust pipeline on track to exceed full year expectations means that that thing isn't doing much at all. But again, fairly small additions to what they're doing anyway. Let's see. Yeah, Interbank is the mortgage loan company that they closed on. That one is really interesting. Again, in a rising rate environment, they're able to charge more interest on those loans, and so you definitely want to be in a business like that. Of course, as the economy cools off and people aren't purchasing as many homes, we'll see that money start to come down, but the great thing about having that mortgage loan servicer is that once you lock someone into that mortgage, you can then sell that mortgage or continue to service it yourself and collect those interest payments year after year, quarter after quarter. So again, great business I think for them to be in. The wealth management is something that they said has cooled off because of the market losing so much over the last 3 months. A lot of people have taken their money out of the market or they aren't doing as many transactions. So um, again, sort of a new business for them. They did add employees and positions to this particular side of the business. Looks like they added 44 positions. This is just kind of where we are right now in our economy, that we have a bank like Regions Financial hiring 45 to 50 new people in a branch of the bank that we know is not necessarily doing so well. So it's interesting. On one hand, we have very low unemployment. On the other hand, we have a lot of nervousness and clear decline in the market. So really interesting to see where this goes. Typically, these positions are uh, are accretive to The bottom line, meaning that these positions are sales positions, so these people are coming in and generating money for the company. The company has within their rights to lay off employees that they don't need. So I'm pretty sure, as we've seen in some other industries, we may see the same thing happening in the finance sector as well if things do continue to slow down, especially in the wealth management industry. All right, what else we got? All right, so that's that there. Um, let's talk quickly about my concern about this company, which is their securities portfolio. Okay, about 20% of their assets are wrapped up in securities, and we do know that the market lost something like 20%, 30% over the last 3 months. Region says that it's a negligible number. There's no need to even look at it. They don't necessarily post this number, even though it is in the financials. Um, but here's the breakdown of their securities. This actually made me feel a little better about what they have going on because all of these securities, as you can see, are basically mortgage-backed securities there, U.S. Treasuries there, corporate bonds there, which can kind of go up and down, more mortgage-backed securities and more mortgage-backed securities. Now, specifically the agency mortgage-backed securities, those are again, they can be volatile, but they're fairly safe. Specifically, the agency mortgage-backed securities, very safe. Most of those are going to be backed by the U.S. government, so you can expect to have a very level, price as far as that's concerned. So even though there will be some variability in the numbers, I don't think, based on this information that we're looking at, that is going to play a huge part in their net income, as the CEO said in the previous earnings call. But again, something that I want to keep my eye on, again, because it can make a difference. And it has made a difference. But again, I feel a lot better looking at this breakdown, knowing that, they're not investing necessarily in equities, but all of these are fairly risk-free government-backed securities. All right. Loan growth. Again, this is where this company is really trying to grow. And again, this is something that they will benefit from with increased interest rates. Again, they're in the business of selling loans. And when you can charge a much higher interest rate for that loan, that is great for your business. And so they are growing loans, however, not by much. And so in every instance, they've said that the loan growth has been stable, right? Meaning that they haven't declined, but we aren't seeing these huge jumps in any sort of loan growth. I don't think that's necessarily a bad thing. I can't imagine that if the economy does slow much more than what it has, we can definitely start to see some declines there. So when I go and I look at my numbers, I will definitely take that into account. All right, deposit balances. This has been a big storyline throughout the last, I'll say, 2 or 3 earnings calls. The bank is anticipating as interest rates get higher, persons will take their money out of the bank and put it in other higher interest earning accounts, meaning that if the interest rate goes to like, it's already at like 2%, but if it goes to like 3, 4%, it doesn't make any sense to keep your money in the bank. At that point, you'd rather put your money in something like U.S. government debt or something in that field, right? Because it's safer and you're going to get about as much return from those investments as you are with the bank. And the thing, though, is that those balances have not come down yet as anticipated, which is great for the bank because the more cash that they have on hand, the more loans they'll be able to make and the less risk that is involved. The good thing, I think, is that they are making plans, though, for these balances to reduce, right? And then every quarter they're surprised that the bank balances, the cash balances for their customers has not moved at all, meaning that as much as we talk about, you know, a possible recession, persons with money sitting in their savings accounts have not really reduced that much. You know, we Americans still have money sitting in the bank, specifically in the areas that this bank services, which is the southeast of the country, Florida, Texas, Louisiana, Carolina. These have, for a while now, for a long time, been places that people move to for better business opportunities, for lower cost of living. And so I think that this regional bank specifically benefits from, you know, location, location, location. And I imagine that a lot of that has to do with why those savings accounts are in such great shape, because while there's so much inflation going on, their customers in their part of the country, I think, are still relatively um, unaffected by the high inflation, just because the cost of living is already, you know, really low in the first place. All right, this is exactly again why you want to own a bank such as this in a rising interest rate environment. Now, I did not do the math on this myself. This math comes from the company, but it says for every 25 base point rise in the interest rate, and this is the Fed funds rate, right? So whenever they talk about the federal government raising the interest rates, this is what they're talking about. Supposedly, the rates are going to raise another 75 basis points. And so, Regions Financial is saying, listen, for every 25, we're going to be putting on about an extra 50 million a year. And so, when you talk about a 75 base point rise, we're talking about what, $150 million over the next year. I mean, that's good money. Again, not looking at the percentage increase right now, but yeah, like I said, man, 150 million over the next year sounds really good, and that's if we get that 175 basis point raise and nothing else. Again, as the interest rates continue to rise, this bank is going to continue to make more money. As they sell more loans, they're going to continue to make more money, and yeah, everything looks good. All right, so non-interest income. I thought this was important because this is again is another huge story in the finance sector. It's a really great thing that consumer protection agencies and the like have really cracked down on and regulated a lot of the non-interest income that banks receive. What non-interest income is, you know, banks primarily make money selling loans, right? And persons are paid back those loans with interest. That's how the bank primarily makes its money, but they also make money uh, surrounding fees, okay? And unfortunately, a lot of times those fees are paid by those without a lot of assets or without a lot of money, right? So when you talk about fees, you're talking about non-sufficient funds fees, which used to be crazy, you know, 25, $35 each time. And it's kind of a shame that, you know, when you don't have a lot of money, you wind up paying more for your banking services than someone with a lot of money. They use more of those services. So we know that those fees are coming down. But again, I think Regions Financial has done a really great job at anticipating that and putting it into the numbers so they have an idea of where it's going. With that being said, um, you know, they're a business and they still want to make money off of these non-interest fees, right? And so, how they go about managing that and do it in a respectful manner is difficult, but obviously they're making it happen. If you look at the numbers compared to last year, they've definitely increased some. The one thing I will say about this, though, is that they are expecting that mortgage non-interest fees, okay, is going to be lower. But we also know that wealth management for sure is going to be lower. And so they're going to definitely have reduced non-interest income. Um, And again, if the economy slows down, when it slows down, we're also going to see less card and ATM fees as well. So again, I think the economy is in great shape just based on how many people are using their cards and grabbing cash out the ATM. I mean, it's grown 7% from last quarter. So people are still spending quite a bit of money. All right, non-interest expense. Again, this is the expense for, salaries, for rent, for lights, things of that nature. It is something to keep an eye on because you want to minimize your expenses at all costs, right? You definitely want to make sure that you have things that you need in order to make the money, but you want to reduce your expenses and your costs as much as possible. They have increased their non-interest expense, and they say that it's mostly due to labor costs. And we know that the cost of labor has increased, specifically with inflation and so forth. Um, so, um, again, something to keep an eye on, but doesn't seem too crazy. They're expecting a slow increase of 2%. I think a year almost, which again isn't great, but what else can you do other than pay what you have to pay and then manage it the best you can? If again we continue to see the interest rate rise and we continue to bring more money in, then that 2% increase in expenses is really nothing. All right, this is another thing that's really important. I talked about this in the last analysis for this company, is the allowance for credit losses. Okay, so what happens is that anytime that the bank makes a loan to someone, they have to assign some numerical value, some percentage of the odds that that loan will not be paid back, and they have to keep cash on hand to cover that loss. Okay, so currently right now the number is relatively small. I don't know if I have it pulled up here, but it's something like 0.17% of all total loans they're expecting to have a loss on. Now, you know, actuaries and finance guys look at these numbers constantly and try to predict and figure out exactly where that number is going and what it needs to be. Unfortunately, some of this stuff it comes from just the news. That's what's been talked about in a lot of earnings calls, which is how much of your decisions about the future are affected by the numbers you're looking at versus what you're hearing in the news. And from the earnings calls that I listen to, a lot of executives are stating that the stories and the things that are spoken about in the news is what's driving a lot of their decisions, not necessarily the numbers, because the numbers look great. But they are expecting some economic uncertainty due to inflation and rising interest rates, right? That we just haven't seen yet. But people are saying that we will see. Either way, they have increased their provision, $60 million. dollars. I'm really curious to see how that works out mathematically compared to the last analysis I did. But it isn't a huge number as of yet, so nothing to really concern ourselves with. That's it. Regions Financial, like I said, doing really well. Rising interest rate environment. The price is about 23. We're in at 26, so we're still down more than 10%. Really looking forward to adding more shares, but definitely will need to do a an analysis to be sure that we're adding at the right place.